Hello, welcome to another episode of Momentum Mondays. My name is Garrett. What's your name?
Matt.
Garrett, Matt. Anyway, we are here to kind of talk about the markets. Last week, markets coming up.
Why don't we talk about something different?
That's a different show, I think. Anyway.
So many things we could talk about.
Yeah, I've got a lot that we're going to talk about. We're going to talk about big reversals, rare technical signals, major economic data.
I was thinking more about the soil scientist you had come out to your house and try to solve your grass problem.
Well, that's a work in progress.
Yeah. Many people don't know this about sometimes when your grass isn't growing, there are things you can do to. It's very interesting.
I have no idea what's happening right now. Anyway, last week, the market flashed one of the most powerful bullish signals we've ever seen. And job numbers, GDP coming up, momentum could shift either way. It could also hit some turbulence.
Momentum never shifts. We stay focused and constant.
It could shift.
But the term momentum in the market
could go up or down, positive or negative. Anyway, I'll throw it to you for the disclosures and we will get this thing started. I've got to reel you in this morning.
Got the caffeine going. Always keep in mind the discussion is for informational purposes only and not personalized investment advice. You get that by consulting with an advisor you trust or visiting us at momentumwealth.us for a free consultation to talk about your specific situation.
Excellent. So last week was a week of 421, and despite Monday's lower close, last week, the S&P was up 4.6%, the Nasdaq up 6.41%, the Dow Jones up 2.4%, and the Russell 2000 4.1%. It's been a very long time since we've seen that much green in those indexes. If we take a look at gold, I'm going to turn your headphones down so that I can satisfy that for you. I don't know which one is yours, but I just did both of them. Anyway, gold down 0.45, silver up 1.69, 10-year bond up 0.56, and Bitcoin, the winner last week, up 10.27%.
Interesting things happening in that space for sure.
Yeah, so we talked a little bit about last week. Did we talk about the divergence between the Nasdaq? Okay, we talked about that, and we saw that continue to happen. Because again, 6.4 in the Nasdaq, 10.2 on the Bitcoin side of things. If we go like year to date, let's look at that. Year to date, S&P's still down 5.7%. Nasdaq's down 7.5 almost. Dow Jones down 5.35. Russell 2000 down 11.95. Gold up 25.85% year to date. Silver up Silver up 14.13. 10-year bond price is up 3.94, which means yield has dropped. And Bitcoin is now positive for the year, 1.28. So lots of interesting stuff happening last week. Really, again, we talk about breadth. That was one of the things that happened last week. We saw some strong breadth, BREADTH. And we saw specifically a rare technical event called a Zweig. I think that's how you pronounce that, a breadth thrust. For only the 20th time since 1945, the market triggered a Zweig Breadth Thrust last week. This is a rare signal that happens when advancing stocks explode higher from an oversold level to an overbought level in 10 days or less. Historically, this has been a very bullish technical indicator for the next 6 to 12 months. So still in the longer term, medium to longer term, I guess, there may yet to be some kind of consternation in the shorter term, though, specifically with when you have the Nasdaq up 1% over the past 4 days, the trading days. That is a signal. It's not really a signal, but it anecdotally, it provides some cover for pullbacks in the shorter term. But again, we're still trending with, optimistic outlook, I guess. I would say 6+ months out.
Yeah. And that's the thing that a lot of people don't understand. If you're watching this and you're new to investing, you haven't talked with an advisor, you haven't turned on your 401k contributions, or if you have, but you really don't understand or don't pay attention to it, it can get very confusing when people such as ourselves are talking about these indicators and talking about positive momentum or the potential for there to be a break to the upside. And it's like, well, there's still a lot of chaos. There's still a lot of uncertainty, tariff this, tariff that. Nothing has really, there's not anything concrete for you to grasp onto. But the market does a great job of being a leading indicator of pricing in things that have a high probability of occurring before they do. We saw this in 2022 before Jay Powell pressed the magic interest rate button. The market just took a giant dump to the downside before interest rates had even moved. And even to some seasoned professionals, that can be perplexing. But what the market was doing was pricing in the impact of what they believed was likely to be substantial interest rate hikes. And it was the greatest percentage change of interest rates that's ever occurred, ever that we know of, especially since the creation of the Federal Reserve in 1913. So the market generally does a pretty good job of picking up on signals and signs of what is most likely to occur in the mid to long term. And when we say long term, we're really thinking 7 to 10 year period. And what would you say a moderate range would be? When people, we use short term. Short term is generally weeks to months.
Yeah, and I would still say that there's some increased chance of volatility in the weeks to months still. I would say that particularly with indicators like that, where you got a breadth thrust, there's a couple of other thrusts that you saw last week happen as far as the number of stocks participating in the upside versus the downside, or the number of stocks advancing versus declining is another way it's said. And that is positive for future growth of the market. But that's a positive outlook for 6 to 12 months later, which we would not really consider short term. So I still think in the short term, and our indicators certainly are pointing to that, still a lot of volatility in the short term. You may see days where the market advances pretty heavily. You may also see days where it pulls back, and that's just something that we have to kind of be comfortable with. And in fact, we pulled the trigger on our first calendar FX trade during this sort of short-term consternation that we have going on in the market. We pulled the trigger on that on Friday. And so this historically, again, what you have is an historically profitable time for the market here in this next week or two. And so that could also be going to, explain why there's been some positive momentum in the market as of yet. So we could get to the end of that period and have a pullback, though. Anything could happen. Yeah. You're still very much in the teeter-totter, kind of we're leaning on the fence, and we're not going one way or the other yet. Yeah,
it's interesting to go back to the thrust indicator that you had mentioned. That goes back to 1945. It's only happened, one side of every a 3-year time set, a series of that on average. Average gains north of 20%. We calculate that in. We're kind of right back to where, us looking at the data, looking at okay, what would we expect? What would be a reasonable expectation to have for this calendar year, knowing what we knew at the beginning of the year was going to come, which was going to be market volatility, market excitement to the upside and the downside. And we're seeing the likelihood of that still playing out increase, generally week after week. But it is very interesting. We have the money supply, which is an indicator I look at a lot, the M2 money supply, still not where it needs to be, but it is increasing, which kind of has you scratching your head because uncertainty generally means less deal making. Less deal making means less large loans. Less large loans means less money supply growth. So it's not increasing a lot, but it is increasing. So that's
you also have whatever's going to happen with the tariffs. Obviously, that's a huge conversation, a huge part of the conversation. There's really no solution to that yet. There's a lot of talk. There's not been any kind of hardcore.
Nothing you can put your finger on. Right?
Yeah, there's not been any deals that are in paper that have been released that says this is what's going to happen with this. But what there is a lot of cargo and things that are going to not be leaving ports headed to this country. So what's the time frame? How far are we removed from supply being an issue of, going in and stores not necessarily being bare, but certainly more sparse than they otherwise would have been.
Yeah, I think you're going to see, which we talked about on the verge of the framework for the tariff being made public, which is you're going to have slimming down of SKUs. You're going to have a reprioritization of what businesses want to keep on the shelf. I think that is the reason why we saw significant discounting the first quarter of the year. We had retail sales still were very good, but we have savings rate increasing, which it's kind of hard to have both. How do you have sales
and wage growth?
Yeah, you have sales blowing it out of the water, but still you have people building excess savings relative to last year. They're paying less for the goods. So we have CPI is also coming down. So there's a lot of things that can be contradictory, and it really takes time to see how it plays out and how it's going to affect the market and the economy. But yes, you got a 7-week round trip on cargo, I believe, coming from Asia. So that question is going to start being answered pretty now, basically, within the next week or two.
Yeah, like 2 weeks. Yeah. So what does that do for the dock workers and the people that are out there unloading those? Do we start to see layoffs in that sector of the economy? And how much will that affect the other part of it? Because it's all connected. It's very connected, because that's what the Federal Reserve is looking at to make their decision about rates. They're not only looking at inflation, they're not only looking at GDP numbers, they're looking at labor specifically. That's part of their dual mandate. They have they have employment and they have price stability. And so you're constantly sort of juggling that back and forth. And so to Trump's point, he would, get on Twitter or X or whatever you call it now and talk about, the inflation is essentially gone, or we've defeated inflation, or however he wants to word it. Mm-hmm. And why isn't the Federal Reserve moving? Or why aren't they doing anything? And the Federal Reserve is probably watching the labor market. And so when you start seeing, it's sort of a double-edged sword, because when you start seeing the layoffs happen, you know that the rate cuts are not far behind. Yeah,
that's true. So specifically, I was looking up because the dock workers operate with the union. So their layoffs, it will end up, if that happens, if we see kind of something similar, especially specifically on the West Coast, because we're seeing a decrease in shipping rates, you could have that feed into the data pretty quickly, depending on how fast the unions go through the furlough process. Because during their furlough, they're eligible for state unemployment benefits. That data gets in pretty quick. You could see that, but as been doing this for as long as we have, we know that the dual mandate, generally speaking, in a business cycle, are at odds with each other. Each mandate is at odds. If you want lower employment, you have to have an easier monetary policy, and so they have this opposite effect, which was put by the Congress as a way to kind of control the Fed a little bit more. The dual mandate was put in, I believe, in the 60s, and so before that it was purely monetary supply. And they really screwed up the Great Depression. That was really in the collective psyche of, the legislatures for a very long time. And so the dual mandate was
decisions were made based on that.
Yeah, the dual mandate was kind of, think of it as trying to control the Fed a little bit more. But yeah, the Fed is, they don't have a really good track record. We think, and this has been a criticism, and there are, you could go back to the COVID timeframe and you can see how they acted very quick, very decisive, in conjunction with the administration and the Congress. It was a uniform effort to keep things from falling apart. So you could look at that from one perspective and say, wow, compare that to 2008. They saved the day relative to 2008. I mean, they really did a great stand-up job if you're looking at the outcome in the short term during that 2020, 2021 period.
We also had different triggers for that, though.
You did, but in 2008, you saw them move very quickly to save the bad actors. In COVID, you had them move very quickly to not have the people destroyed financially. And so you could look at that, but they have basically gotten everything wrong. Even if you give them grace for that, and that's recent history, so we can kind of all think back to that occurring and
you had
see benefits from it. But everything else they get wrong.
Yeah. In the moment, that may have been the case. But what was brought on after that was inflation, which
that's
in fact
fair criticism
destroyed the consumer.
Yes, very fair criticism. Hey, we're going to save you today, but we're going to
kick the can down the road, which is what they're very good at doing,
and let it slowly and painfully, take you out instead of just being a reset period. So there's a lot of criticisms of the Federal Reserve. I think, my biggest criticism is that as a free market, or we have an aspiration to be a free market economy, we still allow the most important price of all, which is the price of money, to be controlled by unelected, unaccountable room full of 12 people, it kind of makes you think of the,
Well, I mean, how was the Federal Reserve created?
In secret.
Yeah, that's exactly right.
In secret.
So
right
it's
before
not
Christmas.
necessarily something new that's happened. I mean, it's always been right here in Jekyll Island.
Yeah. I tried to get my book, The Creature from Jekyll Island. It's a great read. It's very long, but, it was created in secret. And Roosevelt, one of the last things he said before passing away is that he regretted ever signing that. Nobody's perfect. No system is perfect. But it's the system that we have. And I think all the major players in the economy are just sitting here biding their time, waiting for Jay Powell to blink. Now, if he doesn't expect this, I predict this. I'm pretty good with
Prediction
my predictions.
time.
I predict the new Fed, his term expires, I believe, early next year. Generally, what happens is within a month or two of that term coming up for expiration, it's either announced that the current Fed chair will be reappointed or a new one will be appointed. I suspect that if Jay Powell does not move fairly quickly to get the interest rates down, which, we're sitting at 4.5. The Europeans are at 2.5. We're sitting at 4.5. CPI is sitting at 2.6. It is restrictive. I suspect that if he doesn't move fairly quickly, they're going to announce his predecessor much early.
His successor.
Excuse me. I apologize.
He would be the predecessor.
He would be the predecessor. They're going to announce his successor much earlier, which would make him a lame duck. And everybody's just going to look past.
Yeah, but do you even think he wants to continue? I mean, he's been in it for a long time.
I don't think so. And he's a poor communicator. He really. But think back to.
Well, I think this administration has a lot of issues with communication.
Well, I'm not even talking. Yeah, I'm not in that either by design or by a side effect of the way they govern. Right? Who knows? But fair criticism. But Jay Powell has always seemed to want to be transparent in a system that ultimately lacks any transparency. And it just always ends up with just volatile markets. Think back to...
Well, I think he's just analytical. That's the way an analytical mind works, which is that he's looking at data and he's data driven and he's going to say the same thing over and over again. Even if you look at the Fed notes, it's so interesting to look at that because a lot of times it's just crossed out. It's just line itemed through and they just append the sentence or whatever they're saying. Yeah. And so I just think that's how he thinks. He's been doing it a long time.
He's no Greenspan though. He's no maestro.
That's a good point. But who do you put in there if you're not doing Jay Powell? There's been some speculation that he wants Jamie Dimon in there, but would Jamie Dimon do that? I don't know. If you're the CEO of JP Morgan Chase, would you go to the Federal Reserve?
I would like Jamie Dimon, and I don't even know what his inclination is for monetary policy. I would suspect dovish, but he knows the banking system and he knows the markets, and he's an incredibly smart guy. I don't know. I don't know him obviously personally. I'm not sure if you're aware of this. I'm not.
I thought you were talking to him the other day.
No, I was not. I've lost his number. But, just 30,000 foot view is just a, schmuck on the street. I think he's an incredibly...
Give yourself a little more credit than that.
I think he's an incredibly intelligent person. And it would be very interesting. You have to have... I think we're entering a period of time, and it's going to be long-lasting. It's going to outlast this presidency. It's going to outlast the next probably 3 or 4 presidencies. But we're entering a period of time where the American society is demanding onshoring, or at least the protection of the jobs we have left. Artificial intelligence is only going to irritate and that feeling. It's going to make more anxiety in the system as people's jobs are replaced by that technology. And so you're going to have somewhat of a marriage of the monetary policy, tariff policy, regulation, deregulation, banking rules, if you're going to create an environment to where manufacturers can actually build these greenfield projects. I was talking over the weekend, we were at your house for a birthday party, and you have 3 kids. I have 3 kids.
Kids' birthday party. It wasn't an adult birthday party.
We got in-laws that have kids, right? And so there's always there's a birthday party every 3 weeks for children. So, and that's why I have to say no to cake, because if I didn't, I would be diabetic, because it's like every single weekend there's cake.
It's a very good cake. Shout out patty cakes.
Oh, hashtag.
Hashtag
sponsor patty cakes. So, but anyway, I was talking to one of your family members that's got one of your extended family members is working on some projects. Very interesting. Was looking at the project Giant in Memphis, 3,000 something acres, multi-year project to create the electrolytes of products for battery manufacturers. Those things take a long time. You got to have you're going to have tax incentive. You're going to have a deregulation. They're going to lower interest rates. You're going to have something to incentivize these companies to build these giant facilities.
Well, it's all going to take a long time. That's the problem with the conversation so far, is that everybody wants the jobs. Everybody wants to bring things back to America and have people make it, but it's going to be a process because it didn't happen overnight. And so it's not going to be solved overnight. So it's going to be a long road from being able to, order your $10 camping chair and get it delivered in 2 days to your house. That's not realistic. When you look at the price of goods and the cost of manufacturing something, that is divorced from reality.
Yes.
There's a lot of reasons for that. And a lot of them are uncomfortable reasons. You don't want to think about what goes on behind the scenes in these Chinese factories where, Tim Cook can say all he wants to that they provide, good accommodations and good wages to these workers in these factories.
And suicide nets.
Yeah, exactly. You see the real time. They have to live there. They work there. They put nets up around the buildings so they can't jump to their deaths. I mean, everybody sees this. This is not something that's hidden. And so it's a long road from that, and there's going to be some pain. But I think ultimately the narrative that short-term pain for longer-term gain is probably something that really should be more talked about. But the problem with that is how much pain is in the short term. How much pain can people experience in the short term to get to that longer term goal where your neighbor has a decent job manufacturing something or whatever? Maybe it costs you a little bit more, but you contribute to higher cost of living for certain groups and wage growth and all that kind of stuff.
It's a change of mindset that will evolve.
Definitely is a change of mindset.
I think that our society is really built on how many dopamine hits I can get during the day.
Yeah,
and
so instant gratification.
So once I think all you really need is a handful of big announcements and people seeing the bulldozers out there and people seeing things coming up, and that will probably help satiate that need for immediate gratification of cheap goods, because they're saying, hey, well, you know what, my home values aren't going to keep going down because now they're going to build, we were talking near, in a place to be not named, but, near where we live, there's speculation. There's some things in the works of some pretty large factories going up, potentially thousands of jobs. And when people start seeing that the old mill town they lived in, that the home values are actually going to start going up, and, hey, my neighbor can actually, save for his kids' college now. And now, if I own a retail store, I'm going to have new customers because people have, they're making $30 an hour instead of $17 working at the fast food restaurants, or $15.
Yep.
It's going to make a big difference, and it's a moral issue. And I've thought about this long before onshoring got into the zeitgeist of the American culture, going back to 2010, 2011, 2012. And it is definitely a moral issue. Now, some things are going to be made overseas. There is specialization. We want, especially as market participants, we want as close to free trade as possible, because there can be a great exchange of value. But the way the game has been played for so long, I know this, having my wife run a small manufacturing company. We had 8 employees. We, over a 7-8 period of time, she probably moved a couple million in product, 2.5 million, something like that. And we saw, even on a small scale, little cockroaches selling things, right? I mean, just tiny, like Kevin O'Leary would say, you're a cockroach, I can squash you. Right. And he actually competed with us, but that's fine.
But we don't hold it against him.
But on a small scale, we saw how our product with our pictures ended up on Alibaba. Our product with our pictures ended up on Amazon. We saw this.
Yeah, and what's your recourse for that?
There is none.
That's right.
There is none, because you're just a little tiny ant in their world, and they do not care. And it's And it's not just the Chinese. There were European countries before the Ukraine war.
So are they selling it for the same thing you were selling it for, or cheaper?
A mix.
A mix.
A lot of it was just the simple fact that they were able to quickly and easily get things on Amazon with free shipping and be able, which is absurd. Here's the deal. You take my product design, you rip it off, you make it, you use my pictures to sell it. You get on Amazon, which I could not do. It was like you had to imagine. It was an act of God.
Are we bringing some things back for you?
It was an act of God to do it. So then they take the product, they rip it off, they steal it, they use my pictures, they use our reviews, and they sell the product for the same price but free shipping. Now, if I had to sell a product to Hong Kong, it would purchase the product, the buyer would have to pay the price of the product in shipping and wait 2 months to get it. You can't compete with that. And the same thing happened in some of the European countries because, the Europeans, they would say, well, we don't have tariffs. They have VATs. They have value-added taxes.
Right.
So this is
same
what happened.
concept.
Yeah. Somebody in Brussels would buy a product. They'd spend $100 on the product. They'd get the product there. The VAT tax is going to be 100 or 150.
Right.
So we had a wholesale agreement with somebody out of Brussels, and they made some pretty good purchases for a while. And then eventually they got tired of paying the VAT. They went over to Ukraine and gave our products. They reverse engineered it, and bing, bada, boom. Now they're selling it all over Europe, and they ship it to America for cheaper than we can even sell it in America. You can't. So,
Well, that's why there's no, like American auto manufacturers can't ship to European Union or Israel for that matter because of the VAT taxes.
But
so
if it's
technically a tariff.
If it's on the level,
right.
and people in these countries have figured out a way, maybe access to natural resources, maybe skill sets, to make a good product at the same price or less, then let's do it. Let's compete. But when it's
the playing field has to be leveled.
Yes, because these are just man-made obstacles used to screw American workers. And this was all set up after World War II. We came in and said, listen, we're going to help rebuild Europe and Asia. And so we're going to be a friend to you. We're going to, be a bulwark against communism. You can tariff the bejesus out of us, but we'll buy all your product with no tariff. And this is going to be a way to help you. Well, now, 80 years later, they're wealthy countries, and our middle class has gotten utterly destroyed. And people know this. I'm going to get off my high horse, but I'll just say I was speaking with a venture capital guy designing products for the military here in Columbus. He is from Europe. He lives in Germany. He's from Belgium, but he lives in Germany. He's got some of the businesses there, some of the businesses here, and he articulated to me flawlessly the problems with America's trade policies because he knows it, because he's done it. He's built products. He knows how it works. And he said it's just shocking that it's gone on for as long as it has. It's utterly shocking. You basically destroyed the lives of 50 million people that could not get access to the middle class. So things are changing, and don't think that it has anything to do with just a current administration. This is a trend that is only going to continue.
Well, it would have to
for a long period of time. Yeah.
Yeah. I'm not even sure how much progress we'll make during the next 4 years.
It's only 4 years.
Yeah. It's only 4 years. It has to continue beyond that. Yeah. But again, it's going to be a long process, and there are going to be pains, and you're already seeing it with like Temu and Shine or Sheen or however you say that, where they're selling a $2 product and now it's $6 or $7. So I mean, you're still seeing it, and the increase is there, but I mean,
Well, here's a great opportunity for our younger investors, or it doesn't even really have to be younger. If somebody, if you're making under $500,000, if you're making from 50 grand to $500,000, this is for you. This is a great opportunity to even look at what you're spending your money on and say, if the tariff bothers me, if I'm worried about my Nikes going from $100 to $120, how about you just don't buy it and put some money in your 401k like you should have been doing all along? This is a great opportunity when you have things,
easier said than done.
It may be, but when you have things changing and the framework that we're approaching consumerism is changing and altering, it's a great opportunity for you to just check out of the whole thing and say, you know what, if I don't want to participate in price fluctuations, then just reorient your spending. And maybe it's a good time to start in saving and investing for the future and be more of a saver and less of a consumer. and you're going to come out on top when all the dust settles.
Well, that would be to anybody, regardless of income. Be a saver more than you are a spender, but that's hard. That's investor psychology. That's behavior, financial behavior.
Well, let's fix it.
Difficult thing to do.
Let's fix it. Go ahead.
Let's fix it right now. All that to say, it's a long process, and there might be some bumps in the road, and there might be some pain. I think it would do the Trump administration well to communicate that more effectively than they have, especially with all the tariff nonsense that's going on. So here's my 2 cents. Again, we're just two schmucks sitting in a downtown loft. So what do we know?
That's a fair criticism.
But you mentioned home. Interesting home data came out last week. So we had median sales price down almost 2% from February and 7.5% year over year of new homes.
7.5% decline
year over year. Yep, that's right. Used homes, existing homes, actually up 2.7% year over year. Price of those up. Inventory had seen an increase from February and almost a 20% increase from March of 2024. And inventory on new homes was not that much. So interesting. And also the homes are staying on the market longer, potentially indicating cooling demand. Obviously, due to your affordability challenges, your 10-year yield, which looked like it was going to be in favor of mortgages going down, and then it kind of stopped. It is kind of, I'm not sure what it's doing today, but it was going down a little bit last week, that rate. So again, we have the 10-year price up today, so it means the yield is down. Very interesting. So just some interesting kind of
and that's got to be something
around
else that
homes.
the Fed is looking at, because if you have the housing market rollover, you got a lot of problems. So do you wait for it to break, i.e. get it wrong, or do you step in, run the risk of criticism for, being too easy, too quick?
Well, what you're seeing, I think, is a lot of new builders are offering incentives to buy homes that they didn't have to do. I remember looking for a home during the COVID time period, 2021. We were trying to buy a house, and you would go to the showings. I would get there like 7:30 or 8 o'clock in the morning when they first open the house for the showing, and there's a line out the door onto the yard. It's absurd. I mean, people come in and buy the house for, over what they were asking for it. So that's not happening. So you saw all of those new builder incentives go away. They're not going to give you a refrigerator. They're not going to throw $5,000 of closing costs at you. They're not going to do this because they don't have to. So now what you're seeing is that kind of paradigm shift, and you can get some deals. You can get some, closing costs or appliances thrown in or whatever it is.
Yeah, here's something interesting. My brother was talking to me last week about, and I just picked it. I didn't know the exact time frame he was speaking of. I can't remember it, but I just picked one here to look at, and it's true. So we look at new home sales in 2025. It was running around 725,000. In 1960, it was 1.25 million. So we have an 87% increase in population, and we have a halving of the new home sales.
Yeah.
It's a problem. It's a big, big problem. It started years ago. And
there's also the problem of quality of the homes. If you've seen any of these new home builds, certainly in this area, I don't know about other areas of the country, but quality has dropped drastically and the price has gone up. So it's like this game where is it worth it to pay, X amount for a house that's not really built properly? I mean, there's these social media pages all over Instagram and Facebook that I get constantly of these inspectors going into these new homes and showing you all the issues with them, the crooked walls and the, just the simple mistakes, the wood being split up in the rafters and all this kind of stuff that is just, it's not uncommon.
Yeah. But,
how much of it happened before versus how much of it's happening now? I don't know.
That's true. That's a very good point. But, if I'm just, if I go back in time and you look at just a college graduate starting out, before you have a family, I think right now renting would be the way to go.
Well, you have to, yeah. I mean, the average home buyer is in their 50s. Is that right?
Probably. Let's see.
There was a metric that came out a little while ago. It was like mid 50s. I want to say is the average age of the first time home buyer, which is wild.
The artificial intelligence is giving me the answer.
Artificial intelligence.
Wow.
Let's have some crickets playing.
56. Wow.
56. Yeah. 56. That's not great because, previous generations, by the time you were 56, your house was probably almost paid for, if not paid for. I mean, you're getting close to like the end of your working career at that point.
Yeah. So what do you do if you're sitting, because we get this a lot too with retirees that have paid off or have substantially paid down their mortgage. We're going into retirement. Put yourself in this situation. I know each individual situation is different, so the advice we give is different necessarily in each instance. But let's just take and put ourselves in that situation. You're retiring, you're 65. Let's say you have your home paid off. You bought it for $250. Now it's worth $500, $600. You've wanted to say move down to Florida, move to Arizona, retire. I don't know. That situation has changed now. You look at the home
you're going to
prices.
have a house note.
Yeah.
I mean, that's the thing though, is the way that things are going, it's ideal that you go into retirement with as low of as low a debt as you can possibly do that. But a lot of people, that's just not the case, and it doesn't really, we talk a lot about this with cars specifically in retirement, because there is, there are still some manufacturers now that'll do the 0 or 1% or 2.99 or whatever for a period of time. And is it worth it to have the note on the car? Maybe you put a down payment to get the rate down or something, and then pay the note over time if you're drawing from retirement accounts. And this kind of goes into, actually, it's a perfect segue into kind of the sort of topic in mind at hand, because of the market gyrating so much. We're getting a lot of questions about sort of income. And so I wanted to talk a little bit, we're toward the end of the podcast now, so we don't have a huge amount of time, but if we talk about this financial planning concept of sequence of return risk, if this whole idea that, essentially what happens when the market goes down and you're taking income from it, and that's called sequence of return, because ideally you should have plans in place that would prevent the stoppage of your income, that would continue to allow you to pull income from the accounts even when markets are, experiencing vast amounts of turbulence. Timing sort of matters more than you think it does in some instances, and this is particularly one of them. So you have this is the same question with the the vehicle. Let's say you retire and you want to buy a vehicle. Do you take $50,000 or $60,000? That's the other thing with the price of vehicles now. Do you take $50,000 or $60,000 out of the account one time and pay the vehicle off, or do you have a monthly draw sent to you to pay the note on the vehicle, and then as long as your interest rate is not 10 or 15%, does it work out? Does the math work out over time for you to take from that, still allow the assets to grow, and then ultimately have a paid off vehicle? Yeah. But it just takes a little bit longer.
Yeah. A lot of times the best advice comes down to do not kill the goose that lays the golden egg, especially in a high interest rate environment. You want to be very incremental and purposeful. And yes, we're seeing the math really lead a lot of people to make the decision to, instead of doing lump sum withdrawals, to do a kind of a Goldilocks approach, maybe put a little bit of money down and let's take a $700 draw. And allow your assets to earn and go through it. But that's a very great point. And this is where you'll have
a lot of it has to do with the cost of the vehicle, though. The vehicle costs are enormous. I mean, it costs a lot of money for a vehicle now. And you look around and say, why? For what reason?
Yeah.
I mean, they're not particularly. I think that we're not talking about the steel fabricated vehicles from the past. We're talking about largely mass-produced aluminum most of the time. I mean, these are not expensive materials. So why are they? It's a lot so of much money.
A lot of it's regulation to comply with mile per gallon mandates. But we've talked about this in the past. That is electrification is going to push down price, the real price. Now, inflation adjusted, maybe not, but it will push down the real price of cars. It's going to. It's just a matter of fact. I really think this is the dying gasp of of the old way of making vehicles, and it's really going to. I mean, when you go from making a vehicle that needs 1,000 parts for the engine and transmission to work to needing 20
lower maintenance,
90. When you have a 90% decrease in the parts that actually you need to make it, it is going to make the vehicle cheaper over time. So that's just something we're really going to have to pay attention to. If you're buying a vehicle, you need to pay attention to that.
Somebody talking about, I have a van that is gas powered. So there is the little symbol there, the A with the like arrow around it, the auto stop start feature. A lot of cars have this, and it's exactly what you said, regulation. It's to get around the miles per gallon, because if the engine can stop, then you can claim that it gets more miles per gallon than it actually does. They did like a study on that. It basically saves you about $5 in the cost of gas if you keep the vehicle to 200,000 miles. But what it does is cost you more on the other side, because it wears the starter out so much. And that's way more expensive to replace than gas. And so you have this, I don't know if anybody that keeps it on. When I get in the car, I turn the thing off.
Yeah, it's annoying.
It is annoying.
Yeah.
And I've had batteries die multiple times because of it.
So you're having to replace the starter, which the energy that is required to build that starter is far in excess of the $5 of savings, just from how efficient the allocation of resources to make that. And then the batteries that you're talking about, those have to be made, those take, and all that filters into the cost of the vehicle. All of it does at some point in time. So yeah, electrification will push down, technological advances will push down the cost of vehicles. But when you go back to when you were talking about the sequence of returns, this is where sometimes you're going to have a divergence in the talking points that advisors use, or that good advisors use when speaking with clients to help them understand and to try to get them on board to a good financial plan, is when you have your younger investor that's just getting started, they need to really decide on a strategy that works for them. You know, for us, it's momentum driven, it's tactical, using risk management protocols to provide what we believe is the best option for getting good risk-adjusted returns. So once an investor comes on and you're able to get them to see the light at the end of the tunnel of how this is going to work out, they really need to focus on just earning, saving, budgeting. That's really what your younger investors need to do. In the background, we're going to take care of everything else. Now, with which does have an element of a set it and forget it approach while you're accumulating. But once you reach the distribution phase of your life, you know, the importance of understanding how being tactical and reducing risk where appropriate can really be, if not as powerful or more powerful than just white knuckling through the volatility, because you really don't want to experience a 2008 type situation while you're getting your distribution. So you really want to lean on that tactical aspect of portfolio management so that you have a high degree of confidence that your spending is going to go uninterrupted, regardless of where we're at in the business cycle or black swan events like we saw with COVID.
Yeah.
So,
well, it's not just white knuckling through it. It's not just like grinning and bearing it and get through the other side. Sometimes it can be detrimental. So there's plenty of studies out there that show on the way up, your VOOs or your SPYs or your major in broad-based indexes, if you dollar cost average into it, it works fine on the way up. It does not work fine when you're pulling from it. If you wanted to keep that allocation, if you're just buying into an S&P 500 or whatever, and you try to create distributions from that in these time periods where sequence of returns really matter, where you have, you know, rough waters in the market, it can sometimes be detrimental to that golden egg, as you were saying, the goose rather, that's laying the golden egg.
Which you don't want to mess with. So you want to build your buffer of cash, especially if you're taking income. You want to have a tactical approach to be able to tiptoe into sectors to get outperformance, but also tiptoe out of those sectors when volatility is becoming extreme. And that's what we do for our clients in that distribution phase of their life. And, we believe that it works very, very well. So feel free to check it out, momentumwealth.us. Got the plug in there.
Plug. Well, that's a good place to end it, I think. I'm not sure what our time frame is because we started this early, but we're about the same time as we always have been anyway. Well, thanks for watching. If you've made it this far, don't forget to like, subscribe, and share this video if you found it helpful. Again, momentumwealth.us is how you reach us. We're on Instagram, Facebook, YouTube, TikTok now, thanks to Matt.
TikTok.
And so check us out, and we will be back here next week to walk through the markets again next Monday.
Yeah, take care.